Did you know a missed payment, a $10 bet, or buying the wrong type of property could completely cost you your dream home in 2025? That's right, some lenders are making the rules even tougher, and a small mistake could mean big trouble when it comes to your loan application. Today I'm going to show you how to avoid these hidden traps and keep your dreams of home ownership alive. Buying a unit. With the housing affordability crunch, more and more first home buyers are looking at units as their first step onto the property ladder. But did you know more and more lenders are scrutinizing unit buyers in certain areas? You might think that buying a city apartment in a central location with heaps of amenities and future rental potential is a great idea. But here's the catch. A lot of lenders, including the major banks, see inner city apartments as a high risk. Why is that? It comes down to oversupply, market volatility, and specific traits that make these investments for some banks less appealing. It even has to do with concentration. Some of the banks have specific lenders, and if they've lent to too many people in that particular building, they're going to want you to put in a 30% deposit. Or some lenders will just blacklist a building altogether. On my other point though, with oversupply, this can be a real problem because it can be the case where cities are overpacked with similar apartments, and if a bunch of them hit the market at the same time, it presents a risk to the banks. This can drag down prices, and in a worst case scenario, make it harder for the bank to sell. Lenders also shy away from properties under a certain size. With the majority of banks, it's under 50 square meters. There are some that'll consider under 40 square meters, but if you're looking at a smaller apartment or even a studio, you may need to think about getting a bigger deposit. And here's a real world example. One of our clients was buying a small apartment in the inner city Brisbane CBD. They had everything lined up, deposit, pre-approval were good to go, until they signed the contract and we found out that lender actually blacklists that particular building. You see, there was some short-term accommodation in that building, and the bank considered it almost like a hotel. Even though it was our client's intention to live in there and not rent it out, it presented a big issue with this particular bank. Fortunately, we had other banks on the panel who don't see it the same way. That same day, we found another bank that was fine with that apartment and under the home guarantee scheme allowed a 5% deposit. So the takeaway here is do your homework before you commit to a particular property. Have a chat to your broker because the location, the size, and even the type of unit could cause issues with your bank. We've even seen this with body corporate and strata costs, so have a chat to your broker. A few banks have relaxed a little bit on the body corporate and strata costs over the last few months, but if it's costing $10,000 a year in cost, remember that's going to come out of your pocket week to week. Gambling transactions. Now that you know how the wrong type of property can derail your home loan, let's talk about a surprising risk, your spending habits. Even small, seemingly harmless behaviors can cause red flags for lenders, and one of the biggest culprits of that is gambling. You might have had a bit of a bet for Melbourne Cup, a bit of a flutter in the pokies, and it might seem harmless to you, but lenders see it a little bit differently. Although gambling could be considered recreational or discretionary spending, they see it as potentially a recurring expense. So if you have a one-off punt at Melbourne Cup, it's okay. But if every month you're spending $50, $100, $200 on Sportsbet or different gambling platforms, the bank's actually going to consider that as almost like an ongoing liability, and it's going to reduce your borrowing capacity. We got approached by a client a couple of years ago who learned this the hard way. On paper, he had impeccable financials, had great income, good savings, and no major debts. But every Friday, he'd go to the ATM near the Brisbane Casino here and take out $200. Now, he said he was using this for shopping, but the bank saw this as a $200 cash withdrawal from the casino every Friday night. They saw this as an ongoing liability and actually reduced his borrowing capacity by $30,000 to $40,000. But all wasn't lost. He was looking at buying a home in the next 6 months, so he decided to clean up his act, stop those ATM withdrawals, and have clean records. We went back to the bank 6 months later, said, hey, this has all been cleaned up. It's not an ongoing liability. It was, one-off. It's not going to happen again. And they'll fine to reconsider the overall scenario. I think the important lesson here is lenders do scrutinize your behavior within reason. Like if you're going out, you buy an extra pair of shoes, it's going to be okay. That stuff can be explained. But if it's gambling, the banks do take a bit of issue with this. De facto relationships. Here's another fact that catch a lot of people off. It's your relationship status. Sharing your life with a partner is an awesome thing, but when it comes to loans, it gets a little bit more complicated. Lenders don't just look at your financial situation, they look at your overall obligations. And if you declare that you've got a de facto partner, they assume that that de facto person is financially dependent on your income. It gets tricky because you might be just applying just as me as a single person. I say I've got a partner, I've got a girlfriend for a couple of months, but if you say you're de facto, the bank will consider that as two full-grown adults that are having to live off my salary. This can completely shred your borrowing capacity. You could lose hundreds of thousands of dollars if they consider this. Now it gets really tricky because in Australia, de facto is a partner that you're potentially living with 6 months. You might just started dating someone and call them a partner, and it does get tricky. There's a couple of different ways to approach this. If you've started dating, you don't have any joint accounts together, your finances are completely separate, and you're considered completely financially independent, you live separately, you could be considered single for finance purposes. But if you do have joint accounts, you share the lease together, but you might be looking at buying the property just just in your name only. The banks could still consider you as de facto and reduce your borrowing capacity. There's a couple of ways to work around this. A few banks will consider your partner's income, or they'll look at it and say, well, Jaden's applying on his own. Jaden has a partner who is earning $70,000 a year. Show me the partner's pay slips. Although they won't be on the loan application at all, we know that that partner is earning 70 grand. They're not dependent on Jaden's income, and you can still get a loan just based on Jaden's income as a single person looking after just himself to buy a place. A few banks do this. It's called Common Debt Reducer. It's a way to help navigate the situation because it's pretty common and it can be tricky. You might be wanting to buy an investment in your name, not involving your partner. You could have only been going out for 6 months. Well, like, you're not ready to buy a house yet, and that's completely fine. Have a chat to your broker. We've definitely got a lot of solutions, and we've seen this a lot in the past. Financial factors that reduce your borrowing capacity. Yeah, so as I mentioned, getting a home loan isn't just about your income. It can matter about your partner, your spending habits, and even some of your ongoing monthly expenses. Let's deep dive into this so you can understand how these different expenses affect things. Health insurance. Private health insurance is a safety net. It's also sometimes a requirement once your income gets to a certain point, but did you know it actually can impact your borrowing capacity pretty substantially? Yeah, that's right. Even a modest premium of $200 a month can reduce your borrowing capacity by $40,000 to $50,000. The reason is the banks will take this expense outside of your minimum living expense. So for everyone, they have a minimum living expense that they calculate as your ongoing expenses. If you're on, say, $100,000, your minimum living expense might be around $2,000 a month. If you have private health, that's $200 a month, they'll increase your monthly living expenses to $2,200. That will reduce the income left over at the end of the month to make your loan repayments and how much they'll lend to you. Now, it's not to say to go out and cancel your private health straight away before you get home. Have a chat to your broker. I had a recent situation where a client was applying, he had kids that were turning 18, his private health was over $400 a month, and it was reducing the borrowing capacity by $56,000. We found a lender that would actually include private health in his normal living expenses. We explained how it all set up. He was actually living pretty frugally, so his living expenses were below what most other people's was. And we were able to get the loan approved for a higher loan amount, which is what he wanted, without having to cancel private health. So now that you know how insurance can quietly affect your loan, let's have a look at another one that makes a big impact. HECS, or help debt. HECS is one of those things that feels out of sight until the government indexes it or it's tax time, but it definitely can make a big difference with your borrowing capacity. Interestingly, it's not how much you owe, but it's actually your income. If you're earning $75,000 a year, your annual HECS repayment is around $2,625, and it could reduce your borrowing capacity by $28,000. But if your income gets bumped up to $150,000, your annual repayment for HECS goes to almost $14,500, and it cuts your borrowing capacity by as much as $130,000. So should you rush off to go pay off your HECS debt? Well, it's not actually that simple. If you're looking at a higher priced property, if you're looking at investment, it could be worth considering paying off, but chat with your broker to workshop it. If you get an extra $150,000 in borrowing capacity, but it costs you $150,000 to pay off your HECS, it may not be worth it. But by the same token, if you only owe $2,000 or $3,000 on your HECS and it's going to increase your capacity, it could make sense. We cover this with all our clients as part of the first step in an information session to understand what the lay of the land is, what could be preventing or slowing you down from getting to the home of your dreams. If you want any help with that, hit us up at huntergalloway.com.au. We'd love to help out. Now let's look at another factor that seems pretty straightforward, but often trips up people is genuine savings. Most lenders aren't just looking to have a 5% deposit in the account. They want to see a bit of a pattern of financial discipline. Genuine savings shows that you consistently set aside your savings for the last 3 months and built up a bit of a savings buffer. And this is where it gets tricky. Not all savings count as genuine. If you just got given 50 grand from your parents, you might have got an inheritance, that doesn't consider as genuine. Some banks will want that to sit in your account for 3 months. There's a couple of different workarounds on here. If your parents gave you 50 grand yesterday, you're going to buy a place, but you don't have the genuine savings, a way around is showing the bank your rental ledger. Some of them will look at your rental ledger and say, well, while Jaden wasn't able to save up a deposit, his parents gifted him the money, he has been paying his rent consistently for the last 6 months, which would have been the same if you hadn't paid rent, as a deposit. So we'll tick that off. The genuine savings didn't get met, but we have the rental ledger to do that in lieu of, and that's fine to go. There are some other banks that will consider non-genuine savings, even if you have a 5% deposit. Again, a broker will help you navigate this and make sure your loan doesn't get declined for this silly reason. Too much debt. Debt is one of the biggest borrowing capacity killers. Whether it's personal loans, buy now, pay it later, or even unused credit limits, all debt can affect your debt to income limits or your DTI. A couple I helped recently had 3 credit card limits of $50,000, but they barely touched them. They couldn't believe that those credit card limits were reducing their capacity by $150,000. They kept asking, well, I don't even use it. I clear it every month. Why does the bank care? Well, they look at the $50,000 limit and say, well, potentially you could draw that money out, go go to the casino, do whatever you want, and then take years and years to pay it off. We need to factor in the repayments, looking at if you potentially did draw up that 50 grand, even though you don't actually use it. We were able to get the pre-approval done for them saying, well, the bank will lend you up to this much. You just need to reduce your credit card limit to 20 grand when you eventually find the right home. Another thing that trips people up is bad credit history. Your credit history is your financial resume for lenders. It reflects how reliable you've been in repayments in the past. Missed payments, defaults, multiple credit inquiries can make you appear risky, even though your finances are strong now. I was approached by someone recently that had a history of late utility bills. They forgot about it a few years ago, and when we went to go check her credit report, she had a $150 default owing to Origin Energy. This was a complete showstopper for the bank, because if it shows up as an unpaid default, they won't even consider your loan application. She had to contact Origin, pay the $150, which seemed like a silly thing, but still could have derailed her application. Then we did an explainer, told the bank, well, she moved overseas, she went traveling, this is why it wasn't paid, and they were fine with approving the loan. If you haven't checked your credit history, have a look. There's a bunch of free online reports that you can get to see what your credit score is. Pretty much anything over 600, 650 is a pass score. You don't get better rates or anything if it's better than that. Reject after pre-approval. So you might have jumped through all these hoops, got your pre-approval and thought, I'm good to go, I'm ready to buy a house. And a pre-approval is an important part of the process today, especially when we're in a really hot market. But just remember, pre-approval isn't a promise, it's not a guarantee, it's a conditional yes with plenty of terms and conditions. Here are a few mistakes I see made when people get a pre-approval thinking all's good. Firstly, job changes. You might get a pre-approval today, the bank approves you saying, yep, we're happy with you working at McDonald's, that's all fine. But then in a month's time, if you change to Hungry Jack's, get a new job, the bank is gonna have to reassess your pre-approval even though they did it last month. You see, the thing is, you might get your pre-approval today. When you go for your formal approval in a month's time, they're gonna want updated pay slips and information if they see your jobs change, if they see the type of work's change, you might have gone from permanent full-time to casual, it could completely derail your home loan process. That being said though, you might have a pre-approval, get approved, move into the house, and then if you start a new job the next day, it's entirely your choice. The bank is basing their assessment at the time you apply for the formal approval, and they're giving you a loan over 30 years. They know that things might change in the future. You might have kids, you might go traveling. As long as you keep making your loan repayments, they're pretty happy. Taking on new debt. Taking on new debt during the loan process can be a huge issue. I've seen this a lot lately with car leases. It's obviously really appealing. There's different novated lease companies and you can get some pretty good deals on EVs. But here's the thing, the bank will look at the financial lease component of that lease and factor that into your borrowing capacity. Although it might be a much better deal for you after tax, the bank's still gonna factor in that $1,000 lease a month, which is the same as a $250,000 mortgage and affects your borrowing capacity just as much. Have a chat to your broker during that process to make sure it's not gonna derail any plans and work ahead, see if you can push back those plans just to get into the house and go from there. The last one I see sometimes is missed repayments, especially if you're getting a pre-approval with the same bank your day-to-day accounts with. I got contacted by someone actually just yesterday. She had banked with her same bank for the last 30 years, had saved up the deposit, was applying for a pre-approval. Everything was going really good until it didn't. She said the bank said out of the blue she was rejected. What had happened was a direct debit was coming out from one of her accounts that she forgot to put enough money in. So every month her account was overdrawing by $20. $20, it'd overdraw for a day, she'd fix it up. $20, it'd overdraw and fix it up. But see, in their system, the bank saw her as a bit of a risk, saying, well, she's constantly missing her payments. This account's always overdrawing. We think she's a risk. We don't want to lend to her. And this is where you need to be careful, especially when you're applying for a loan. Banks sometimes don't really look at the full picture. They didn't realize that she had her $30,000 saving in another account. She had the money there. It was just a bit of a mistake with her management. So missed repayments can make a big issue, even if it's a small amount. So keep that in mind. Make sure you stay on top of your accounts and potentially consolidate. If you've got accounts here, there, and everywhere, try and get it down to just a handful of banks to make sure you're across everything. Oh my God, I feel like we covered a lot today, but as you can see, there's a lot of things that can go wrong when you're applying for a home loan. You want to work with a broker that has lots of experience, lots of good reviews, and can help you get through the home loan process and into your home. At Hunter Galloway, we help people all around Australia. We specialize in the home guarantee scheme. So if you've got a 5% deposit, or you're a single parent, we would love to help out. Or if you're looking at something bigger like upgrading, hit us up. 2025 could be your year to jump into a new home. We'd love to help out. Like I said, hit us up at huntergalloway.com.au. And until next time, I'll see you guys.